Hey everyone, so Netflix just reported their Q1 2022 results and they were not well received by the market. In after hours, the stock was down 26% and it may be down more or less once the market opens today. But as of right now, from its peak, the stock has now declined almost 70%. And on top of reporting some very weak earnings and weak guidance, which I'll talk about in today's video, Reed Hastings, the founder and CEO of Netflix, had some really interesting comments to say in the interview or conference call that they do every quarter, some things about potentially an ad-supported tier, and some other ways that they're going to monetize their business going forward, and some of the challenges that they've been facing. In today's video, I want to break down all of the things related to their quarterly earnings, as well as give my opinion from a value investing perspective of how I'm handling this investment situation, because I am an investor in Netflix, and I think there's a lot to learn in how I'm navigating a business where I've invested a lot of money and the stock has gone down more afterwards, or potentially things have changed in the business after I've made the initial investment. If you enjoy these kinds of updates on earnings and want to see more of them this earnings season as it's just getting kicked off, then make sure you let me know by leaving a like on the video and letting me know your thoughts down in the comment section below. But with that said, let's jump into the video. Before I get into Reed Hastings' comments on the conference call, which I think is the most interesting part about this quarterly earnings, I want to go through some of the headline numbers and guidance and why the market reacted in such a negative way to this particular quarter. In the quarter, revenue came in at $7.9 billion, which was a 9.8% increase from last year. Operating income came in at $1.9 billion with an operating margin of 25%, which was higher than Q4 and basically in line or a little bit less than Q1 of 2021. But the big number that people are looking to is the total paid memberships, which came in at 221.64 million, which is actually still a 6.7% increase from the same period a year ago, but is down from the last quarter, 0.2 million subscribers. On top of that, they guided very weak going forward into the next quarter. So for Q2 2022, they're expecting $8.1 billion in revenue, which would be a 9.7% increase from last year, 1.7 billion in operating income with a margin of 21.5%, and they're expecting to have 219.64 million subscribers at the end of the quarter, which is 2 million less than even the end of this quarter. So the big headline number that you're probably seeing on all of the articles is that there's a decline in subscribers, and I believe this is the first time that this has happened for a quarter where the overall Netflix business has seen a decline in subscribers. And there's actually a lot of reasons that go into what drove this. I'm sure some headlines will point to certain things that management said during the quarter, but there's really quite an array of things that altogether have combined to ultimately result in a slight decline, but certainly no increase in the number of subscribers during the quarter. The management team cited 4 key reasons in their press release as to things that are influencing their business this quarter and will likely continue to influence their business going forward. The first is that in terms of their addressable market, which they believe is about 800 million to 1 billion households globally, the rate at which Netflix can be adopted globally is very much out of their control. There's many things within the addressable market development that Netflix can't control. And one of those key things is the adoption of smart TVs. The vast majority of people who watch Netflix and these other streaming services do so via television. And that of course requires that you have the hardware, a smart TV, that can do that. And while in the US, for example, smart TVs are very penetrated, that's not the case in many other regions where they're trying to expand their business. And Netflix cited this as a reason as to why they're unable to get the adoption of subscribers that they were expecting as quickly as they were expecting in some of these developing areas. They also spoke about account sharing, and they spoke about in the US in particular that they believe there's 100 million people who are using a Netflix subscription and not paying for it, meaning that there are multiple households using the same subscription. And they talked about how this wasn't really something that they had planned on addressing for a very long time, because as their business was expanding, it actually worked as a marketing tool, essentially allowing people to share their accounts allowed people who wouldn't have paid for a Netflix subscription to see the content, fall in love with the content, and then ultimately, if two households were sharing an account, then they would likely upgrade to the premium tier, pay more, and they would capture some revenue in that way.
We realized, with all of the account sharing, which we've always had, that's not a new thing. But when you add that up together, we're getting pretty high market penetration. And that combined with the competition is really, what we think is driving the lower acquisition. And now we're working super hard on it. And, remember, these are over 100 million households that already are choosing to view Netflix. They love the service. We just got to get paid, at some degree for them.
But particularly in the US, as they reach this massive penetration in the market, especially if you include these dual households using the same account, they're looking for additional ways to capture revenue from those people. And one of the most obvious ways they're going to be able to do this is simply through increasing the price of within the subscription. So they're thinking about adding something called sub accounts, where if you have multiple households, you can add another household onto your account. And that's really going to be the only effective way to do this long term, because it's going to be extremely difficult to figure out who is sharing accounts and who lives with who and who doesn't live with who. And it's also kind of a violation to go too specific into figuring out who lives with who and what are the account sharing situations for people.
And the principal way we've got of going after that is asking our members to pay a bit more to share the service with folks outside their home. So if you've got a sister, let's say, that's living in a different city, you want to share Netflix with her, that's great. We're not trying to shut down that sharing, but we're going to ask you to pay a bit more to be able to share with her. And so that she gets the benefit and the value of the service, but we also get the revenue associated with that viewing.
The third factor is competition on engagement. And this has been a factor, but they don't believe it's actually been one of the key reasons why the business has seen a slowing in their subscriber growth. In fact, if you look at something like Nielsen data, which does great analysis of how people in the US are spending their time consuming entertainment, the overall streaming category is continuing to grow as expected. And Netflix continues to be the largest individual part of that streaming segment. So what this means is, even as their subscriber growth globally slows down, if you look at their most penetrated market in the US, the way people are spending their time is predominantly on Netflix, and continuingly to be Netflix is continuing to be a larger and larger part of how people spend time being entertained. And that's a testament to the content curation and acquisition that they've been doing over the past few years and getting better and better at. And it also indicates that the new competition from HBO Max and Disney Plus and Paramount Plus and these other streaming services that are coming online now hasn't had that much of an impact of how people are consuming content on Netflix or YouTube or these other services. So that's a really good sign for Netflix, in the US at least. Obviously, there's significant challenges that they're still facing outside of the US. And outside of the US brings us to the fourth key factor, which is macroeconomic factors. So things like the Ukraine-Russia conflict, specifically when they withdrew from Russia, there was a 700,000 subscriber loss that they had. So in fact, if you actually remove that loss of subscribers in Russia, which was a strategic move, it wasn't people deciding to leave, Netflix stopped allowing the service in Russia, then they actually had a subscriber gain during the quarter. So that was a big impact. And there's other impacts going on around the world, especially Latin America, which is one of their fastest growing segments, or has been their fastest growing segment for a very long time. There's a lot of macroeconomic problems going on there. Inflation is high, GDP growth is low in a lot of those regions, and that is hurting their business, which is ultimately, it's a discretionary purchase. People don't need a Netflix subscription. So when they're tight for cash, they decide to cut things like Netflix, and they're seeing a little bit of that. It's easy to forget if you live in the US or Australia or one of these countries where the pandemic was handled on an economic basis fairly well, where they gave a lot of stimulus to people and businesses. You kind of forget that there are many other countries around the world where that wasn't the case, where governments didn't give their citizens and the people living there a lot of stimulus. And in those areas, a lot of people are struggling at the moment. So it makes sense that businesses that operate on a global scale, especially in a discretionary way where Netflix isn't a necessary purchase, it makes sense that they may see some struggles continue at least over the next year, maybe even longer. On the conference call, Reed Hastings and the other executives on the management team had a couple of very interesting things to say about the quarter in particular, but also about things they're thinking about in terms of developing Netflix over the long term.
Greg's done great work on the price spread. And one way to increase the price spread is advertising on low-end plans, and to have lower prices with advertising. And those who have followed Netflix know that I've been against the complexity of advertising and a big fan of the simplicity of subscription. But as much as I'm a fan of that, I'm a bigger fan of consumer choice and allowing consumers who would like to have a lower price and are advertising tolerant get what they want makes a lot of sense. So that's something we're looking at now. We're trying to figure out over the next year or two. But think of us as quite open to offering even lower prices with advertising as a consumer choice.
This was something that they previously thought couldn't add incremental revenue, but clearly they've seen the success of Hulu and Disney Plus, and I think even HBO Max runs this model, and of course YouTube is an ad-supported model, and they're thinking about implementing something along those lines at some point over the next couple of years, and they were pretty clear that this isn't a response to this poor performance in this quarter because they can't turn on an ad-supported model and fix the short-term problems that are going on right now just like that. This is a long-term kind of solution or change to the business that they've been thinking about for a little while. So now I just want to share my opinion on this, especially from someone who is a value investor and invested in Netflix. And I think the reason why I want to do that is certainly not to persuade you either way towards Netflix as an investment or away from Netflix as an investment. I want to talk about it from an education perspective, to teach you and show you as an example how I'm approaching this as a value investor. What am I doing? Because I've invested a significant amount in Netflix after it already fell 30%. It's now looking like it's fallen another 25%, maybe more once the market opens. So what am I doing? Well, the big question here is, has what's happened in this quarter, are we seeing things that have impacted the long-term competitive advantages that Netflix has? Personally, I don't think so. The long-term opportunity, 10, 15 years out, is still this massive 800 million to 1 billion households globally. And as I mentioned a little bit earlier, there's some development that needs to happen. Broadband speeds need to get better in developing markets, and smart TVs need to be rolled out and penetrated across developing markets. So there's room for that to continue to expand. Those 800 million to 1 billion households cannot all get Netflix right now. They just can't, right? They don't have the internet for it that's fast enough, or they don't have a TV that makes it a really good experience. But over time, that opportunity is still there. There is still a massive trend away from linear TV, so pay TV and broadcast TV, towards streaming services. And Netflix is in a great position to capture a significant amount of that engagement and therefore a significant amount of the dollars spent on entertainment. And then in the US, which is their most penetrated, developed market, they are still the leading streaming service by subscribers, but also by the amount they charge per subscriber. And even though they charge more per subscriber, they have the most subscribers, they have the best retention rates, and they have the most engagement in terms of how people are spending their time. And all of those things combined is a very, very good indication that they have a powerful competitive advantage, that they have something so good in the US at least, and some of these elements are true internationally as well, but certainly in the US at least, their product or their service is so good that more people are willing to subscribe at a higher rate and stay on the platform more than any other streaming service. And that's a really good indication that the long-term fundamentals of the business are still unchanged. So then the other question that needs to be answered is, has the valuation changed, right? And we can think about it like this. The stock price has come down 25%, right? So, and I was willing to buy the stock before it fell, right? So the question here is, has the valuation dropped less than 25%? Because if it's dropped to less than 25%, then the stock is an even better deal than it was when I was buying it at $350 a share. If the value of this business hasn't dropped at all, if nothing's changed over the long term, then the stock is about 25% cheaper than when I was happy to buy it previously, and that would mean, of course, that I would be very excited to buy even more of the stock. And in my opinion, the valuation, or at least my valuation of my projections of the business, haven't really changed. Certainly, I'm much more confident on my more conservative models. So when I'm projecting 10%, I'm much more confident than the models where I'm projecting 18%, for example, per year growth for the next decade. But overall, the range that I have for where I think revenues and cash flows will be in 10 years hasn't really changed. And the key reason for that is because there's nothing in this quarter that can give me a good indication of the long-term value of the business that's negative. All of the negative things are really, a lot of them are related to macroeconomic problems that are happening around the world, things that are out of Netflix's control and don't impact some of the most important things for the long term, which I just mentioned, which are retention and whether they have pricing power and those sorts of things. Those things are not changed. In fact, engagement was up. The Nielsen data showed the viewing was up. The viewing watch minutes for some of their big shows during the quarter actually outpaced expectations. So the people who are using Netflix are using it more often, they're engaging more often, and those are the things that influence my long-term valuation. I have no idea what's going to happen over the next year, but over the long term, I'm confident that they can continue to gain subscribers globally, increase their prices with pricing power, and get to where I think they can get in terms of revenue and profitability. And because my valuation hasn't changed, all it means when the stock price is coming down is that I'm getting a larger and larger margin of safety, margin of error when I'm investing in the business, meaning the business has to perform less well in the future when I'm investing, right? If I'm buying at 500 and then I can buy at 250, buying at 250, the stock will double to 500. So it needs to perform half as well than when I was buying it at 500 in order to make me a 15% return, for example. But that's all for Netflix's earnings. Hit subscribe if you want to stay up to date with the content that I post in the future. With that said, hope you guys have a great week. I'll see you in the next video.